Shelley, this is the latest evolution in this kind of progression in the ETF business over the last couple of 2 or 3 decades at this point, from almost being focused exclusively on passive or index type tracking instruments to now seeing a boom in the number of these active managed ETFs. What exactly has been the primary driver in your mind of that kind of dramatic shift that we're seeing from index passive type investing that appeal to the masses, like a fire and forget type strategy, if you will, to now having one where investors are maybe even actively seeking outperformance above and beyond an index return?
Well, we're seeing a lot more financial advisors use active ETFs in their model portfolios. Recent data shows that about 1/3 of financial advisors are using an active ETF in their model portfolios when they're managing their retail clients' assets. Also, you've got the investors, the sort of do-it-yourself in ETF investors, and they are also flocking to active ETFs. Latest data shows that there's about $100 billion of direct investment by retail investors in active ETFs. So, there is this appeal. Also, ETFs, they have broad appeal across sort of the age range. About half of ETF retail owners are between the ages of 35 and 64, but a quarter of them are under 35. And a lot of these investors are attracted to more of these innovative ETFs and these thematic ETFs, as I was saying before, the cutting edge tech, the cybersecurity, crypto. They're looking for those exposures.
Okay. Now, Adam, a final question to you before I get to Shelley with her final question. My final question to you is, as you look out for the balance of this year, given what you've seen in terms of your investor flows, given what you've seen in terms of interest in your funds, given what you've seen in the portfolio dynamics of your underlying products, what do you best guess could be the outcome that we have going into the fourth quarter of this year and the first quarter of next? Is this a bull market that can keep continuing, or are there real storm clouds on the horizon in your mind?
Gosh, I mean, putting aside the geopolitical risks that we're dealing with daily, the big trigger, I think, is interest rates and where that goes over the next few months. Hopefully, for the sake of the market, I'm hoping for a drop in rates. But I think the biggest challenge that investors are going to have, regardless of where the market goes, is the fact that the S&P 500 and the Qs are so over-concentrated in their top 10 holdings, and that the exposure they're providing has tremendous overlap. So I think it's 35% of the S&P 500 and 45% of the Qs are basically in the same companies. So all these investors who think they're diversified, what they are going to find, God forbid there's a large pullback, is that these mega cap tech companies are going to hurt their portfolios. So I think what we're seeing now, and what I would encourage investors to do, is to diversify. Regardless of whether the market's going up or down, you need to diversify, and you need to diversify in your core equity as well, because the main indexes are not diversified anymore because they've had a historic run up in the mega cap tech companies. And that's why products like ours and others that are more value tilted or quality tilted are starting to get more traction, because investors are looking to get into different types of equities that they don't have as much exposure to, and get ready for a downturn if in fact there is one.
All right, so that's that side of the equation. Shelley, in addition to being the chief ETF researcher for the Investment Company Institute, you're also the chief economist. I'm going to ask you to put that economist hat on here. You watch the data, you've seen it come in. We've heard of many other economists and their views on what the economy could look like in the coming months for the U.S. What exactly do you think is going to be the base case scenario for the U.S. economy over the course of the next couple of quarters?
Over the next couple of quarters, I mean, certainly the employment report that came out on Friday was very disappointing. And I think that has, cinched the case for a rate cut in September by the FOMC. So we'll definitely see the funds rate a cut in the funds rate in September. Going forward, depending upon what the labor market looks like, and then, we're also going to, at the end of this week, get some inflation data. So that's going to be key to the Fed's decision as to whether to accelerate the path that they have for rate cuts going forward. Right now, the market is pricing in 3 rate cuts, and that's up from the 2 they had previously. I think that we'll see a slowdown in GDP. Are we going to go into a recession? Maybe not. The Fed is going to be very proactive on trying to support the labor market, but they do have the dual mandate, and they are going to watch those inflation figures very closely. And so while they'll continue to cut rates after September, the pace of those rate cuts are going to depend on the inflation numbers.
All right. A lot of data to ponder and think about for sure. My thanks to both of you, Adam Patty and Shelley Antoniewicz. Now, we've asked Shelley to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.